investors at Search Burger here. Well, I continue to enjoy that South Florida lifestyle. We started the year so far in terms of the stock market on a pretty good note, but I want to do a quick video here because a bit of an update of where we are, and I think we're potentially heading into a somewhat riskier period for the stock market. Before we do that, though, real quick, want to remind you, for those of you who haven't seen it yet, that we are going to be having our first ever Study Trader Signature Series Mastermind event. That's going to be this February 6th to 7th in Orlando, Florida. The link to sign up or for more information on this is down below in the YouTube comment section, and also in the video if you are clicking to this video through an email. So let's talk about the market real quick and just kind of go through a couple things. So first of all, if you look at the calendar, we are slowly but surely heading into the second half of January already, and we have two major things, two major catalysts out there. Number one, of course, is the presidential inauguration scheduled for January the 20th. And if you really think about it through the lens of sort of what has happened over the past couple of months, the entire rally that we saw in stocks, which is this blue line here, has essentially been on the hopes of somewhat of better conditions for the economy under a new administration. For better or for worse, that's arguably what has been the trend, and also some better economic data actually. So now that the new administration is going to come into power, we'll have to see what the reaction to the market is. Was it a buy the rumor, sell the news thing? We'll have to see, but that's why I want to throw out a bit of a cautionary note today. That's number one. Number two is corporate earnings season is starting to kick off here, so we'll have to see how the fourth quarter went and what the outlook is for corporations. So that too could potentially cause some more near-term choppiness. I am quite positive on the U.S. equity market for 2017, but for right now, I'm a little bit wanting to just throw out a bit of a cautionary flag. So if you look at the S&P 500 again, that's that blue line. I pegged it against the VIX, which is the volatility index, in red. You can see we are seeing this diversion. Once again, a very big wide, so stocks are very high versus implied volatility, which is very complacent, i.e. very low, in fact, still below the 12 mark. So that sort of gap ultimately will have to mean revert. It always mean reverts. You can see it here over the course of time. It has always mean reverted. Most recently, actually just mean reverted in late October, early November, just before we started to see the rally. So I think we're getting quite close again to a point where that will have to happen. If you look at the broader stock market through various different indices, for example, if we just look at the XLF, which is the financials sector ETF of the S&P 500, you can see here very clearly we are in consolidation mode. We are seeing this kind of movement here. So, from that perspective, really, we could see a break in either direction, but we're seeing, this divergence between implied volatility and stocks. We are also seeing a lot less sector and group rotation. We saw a lot of group and sector rotation coming out of those on the back of the U.S. election, and actually heading into it, we already saw financials outperforming. Right now, we're seeing quite a bit of complacency on that. Even if you look at this in relative terms, you can see the financials versus the S&P are really just kind of treading water. There's no real relative strength, excuse me, and no real relative weakness. So I think taking some chips off the table for those people that made money over the past couple of months is probably a decent thing to do here. I think reward to risk is getting a little bit worse, and potentially we are in for a bit of a choppier period here. So take that for what it's worth.